Why Americans do not see a strong economy despite the massive improvement in GDP figures. It's very easy to talk about a huge and strong economy, but when you look at the disaggregated figures, we need to be especially careful because they show us a lot about why citizens do not see the economy as strong as it looks. One of the most important factors to drive the GDP higher in the fourth quarter was a reduction in the GDP deflator. Less than half, actually. What happens then is that the GDP deflator comes down dramatically, and therefore the real GDP figures look a lot better. That doesn't mean that the GDP deflator is badly calculated. It just shows that the official measures of inflation, the GDP deflator, CPI, etc., do not reflect the reality of what citizens are suffering in terms of inflation in non-replaceable goods and in their daily lives. Therefore, consumption appears much stronger despite the fact that Americans are not buying more things with the same salary, but less things and at a much higher price. It is also very important to understand that the GDP figure in the United States was bloated by massive debt. $1.5 trillion of GDP increase in 2023 for an increase of $2 trillion in public debt. That is not a strong economy. In fact, it is the worst economic development since the 1930s adjusted for debt. And in this graph, what we show is that the difference between GDP and gross domestic income, gross domestic product and gross domestic income have moved in completely separate directions. And it's important to understand this because we have to pay attention to gross domestic income because it also shows the reality of the US economy, which is closer to stagnation, even recession, than what the very aggressive growth shown in GDP. A lot of scholars have talked about this huge discrepancy and the important effects, but it's important to understand why US citizens don't see themselves in a situation in which things are improving. Number one, their affordability of goods and services is getting much worse for the things that they pay every day. Number two, credit card debt is at an all-time high, and this is a very important risk because citizens are basically making ends meet by taking more debt and taking longer to repay those credit card debts. Number three, those accesses to the housing market and to the overall improvement of life through taking healthcare, taking education, housing, etc., those are rising much faster than the GDP deflator and certainly than CPI. Let's go to the next graph because it also shows something very important. In terms of the United States economy, you cannot say that it's a strong economy when the interest expense on the debt outstanding is rising dramatically. What it's basically showing is that the United States is going down Europe's way and Japan's way into bloating the economy with public debt, which means much higher taxes, much lower growth, much lower real wages in the future. I always say to American citizens, I come from the future. I'm recording this clip in the euro area. What you are basically witnessing in the United States is destroying the potential growth of the US economy by bloating government spending and bloating government debt. And this interest expense is likely to continue to be elevated, particularly because debt is not coming down. More importantly, at the same time, governments continue to spend way more than receipts, even in an environment in which the economy is allegedly growing substantially. Let's go to the next graph. This one, courtesy of Ned Davis Research, shows us that very significant element of the net interest expense, because this increase is not driven by tax cuts. Taxes have increased. It's not driven by a weak economy because the government tells you that it's a strong economy. And certainly it's not driven by an environment in which receipts are not in a relatively positive environment. No, it is driven entirely by a massive increase in the expenditures. And a massive increase in expenditures, you would think, would be basically to support the economy. No, the vast majority goes to current spending and the level of political spending that generates a much lower growth in the future, which is what the CBO, the Congressional Budget Office, shows as well, which that shows that the potential growth of the US economy is actually getting worse, not improving. Let's look at the next graph, also courtesy of Ned Davis research. In this one, what we can see is that is the difference between federal outlays and receipts. And this is important because everybody tells you that it's a problem of hiking taxes. If you hike taxes, then everything will be solved. Not true. Look at that. In reality, what it's showing is that receipts are actually, every time that receipts go up, the government spends a lot more. And when receipts come down, the government spends a lot more as well. So be very careful to believe in the fallacy of higher taxes to reduce the deficit. But now, obviously, the MMT defenders will say that deficits are not a problem because they are basically generating reserves for the private sector. Well, it is not true. Deficit spending is not a tool for growth. Deficit spending is a tool for cronyism. Deficit spending is not something positive. Deficit spending is a massive burden on the future that generates less growth, weaker real wages in the future, and higher taxes. Always, it's not a level of receipts that you would accept in any shape or form would be increased. There's no way in which you could get these receipts up by $2 trillion every year on the dot, no problem whatsoever with tax hikes. Makes no sense whatsoever. So the next time that you hear that the United States is in a strong economy, think twice. Citizens are suffering the burden of both the expansion and the contraction. Why? Basically, what is happening is that families and small businesses suffer the problem of monetary expansion and huge government spending, but through inflation on the way in, and they also suffer on the way out when the central bank increases rates and tries to control inflation, because families and small and medium enterprises, suffered all of the burden of the interest rate hikes and the monetary contraction. The one that leaves completely unscathed because it passes the problem to you as a citizen is the government. Deficits are not a tool for growth. They are a tool for stagnation. If you don't want to end up in stagnation like the euro area, think twice, because with that, what you need to also think is that you will see worse unemployment rates than what we see right now. A bloated economy is not a strong economy. A massive increase in debt is not something that shows that the economy is strong. Keep defending freedom. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.